It is possible. It's happened. Look at Disney, down 5.3% as of 4:08 p.m. today. You are going to be watching us. Video will be up within the next 20 or 30 minutes. This is what you get from this channel. So if you're new, subscribe. We respond quickly. We make videos very quickly, and they're pretty freaking good videos. So here's what Disney did. They missed bad. They got 30 cents actual EPS versus 51 cents expected. And they did $20.15 billion in revenue versus expectations of $21.26. A little glimmer of hope here. Disney Plus subscribers was 164.2 million, which beat estimates of 162.5 million. It is still down 5% after hours. Guys, the all-time high for Disney is 203.02 last March in 2021. That is 18 months ago, 19 months ago, 20 months ago, whatever it was, and it's down over 50% from there. This is Disney, guys. This is a company that's been around for a long time. This is a moat business. This company is one of the companies I want to own in the future. The question is, can you pay the right price for it? So if you're new to this channel, this is what I do. I'm a value investor. I don't chase what I want. I'm patient for what I want at the price I want it at. So the question is, what is Disney worth to us? We use our 8-pillar process to figure it out. Let's look at the income statement for Disney. So they did $20 billion in revenue, even though, now remember, I'm a value investor. I couldn't give a rat's behind about the quarter results in terms of missing or not missing. I use these gyrations in the stock price because of results to sit there and use as an opportunity to buy when things are bad. If they miss, I love it. Why? Because unless something fundamentally is changed in the business that's going to change the business's revenue and profit for the long haul, 10, 15, 20 years, I could not care less. They're going to miss from time to time. I'm okay with that. In fact, I prefer that. It gives me an opportunity to buy, and it tells me they're probably not cooking the books because I don't want a company that always hits their target because it makes me wonder, what are they doing in the financials to make sure they always hit their number? So let's look at our 8 pillars on Disney. Oh boy, a lot of red. Guys, this is all probably driven by COVID. I mean, shares outstanding high, a lot of debt because they're free cash flow. Oh wow, look at this. Jeez, oh Pete, guys. The free cash flow is so low. I'm sure this is low compared to history. Yeah. I mean, look at their free cash flow in years past. Really high numbers. $6, $7, $8, $9, $10 billion. And the last 5 years, averaged $2 billion. I mean, this is just a tough go right now for the company. Let's look at analyst estimates. But remember, these are opportunities to buy companies potentially. What was it at before COVID went? So what was the stock at during COVID? Before COVID, the stock hit 150 and fell to 86 bucks. Wow, we're close to, the low was $90 recently, and it fell to 86 during COVID, 85 bucks. Analyst estimates, they expect profit to triple in the next 5 years. So look at this, guys. Look at this. 386 this year to 11 bucks in the next 4 or 5 years. Big time growth because it was bad before. Revenue, expect to grow high single digits. Okay, so I look at this guy saying, okay, let's say Disney, you think in 5 years it's going to make $11 a share. Multiply that by 15 for a PE of 15. You're talking about $165 a share is what it would be worth in 5 years. So when it was selling for $200 a share last year, my question is, I mean, even if it hits here and sells for 20 times, there's not much room left for profit for you to make money because you're paying essentially what it's going to be worth in 4 or 5 years. All right. Pardon me. So, oh man, this is a doozy. Let's go see if their investor release is up. Their press release is up. Yep, here it is. Okay, let's see what it has to say. Walt Disney Company reported revenues for the quarter and year grew 9% and 23% respectively. Okay, so 9% versus last quarter, 23% versus the quarter last year. EPS was 9 cents, excluding certain items. EPS was 30 cents versus 37 cents in the prior year. So this is excluding certain items. So, okay, they still had a drop. Diluted EPS for the fiscal year increased to $1.75 from $1 level in prior year, $1.11 in the prior year. Excluding certain items, diluted EPS increased to 353 from 229. So they're making progress on the year to year. This is what I mean, guys. On a quarter to quarter basis, it may look bad, but look at it from a full year, multi-year perspective. Are they on the right trajectory to get much higher EPS? Do not worry about the quarter to quarter results. Use the quarter to quarter results to figure out if the business fundamentals have changed. If they've not changed, that's fine. They're going to miss from time to time. It's okay. Don't react because everybody else is reacting. Let's see how much everybody's reacting. Oh my God, look at this, Tim. They're down 7% now. Guys, this is $8 away from the low during COVID when they shut down the parks. I mean, come on. I'm not saying it's a good buy right now. I'm just sitting there saying, if you thought it was a good buy at 85 when it shut down its parks, why would you not buy it now? I personally am not buying it now, but we're going to do the stock analyzer tool to figure out what to pay for it. Let's look at what they're also saying here for investor relations. All right, 2022 was a strong year for Disney with some of our best-selling storytelling, etc. All right, here's some numbers. All right, so here it is. Year to year, 23% increase in revenue, 9% quarter to quarter. Okay. Let's see. Income from operations increased. Diluted earnings per share decreased. Free cash flow, big drop. 47% year over year. Just compared to the quarter, 10% drop. All right. I mean, this free cash flow is low, guys. The market cap of the business is how much? The market cap for the business is currently $182 billion. The free cash flow for the last year is 1.4. For the last year is 1.059. That's rough. It's 180 to 1. Now, again, multiply this by 10. If it was normal and it was $10 billion, let's say, it's still 18 to 1. Still not cheap, but Disney is a high moat business. If I gave you $180 billion today and said replicate Disney, you wouldn't be able to. And that's kind of the idea. Like, what is it worth at some point for the moat it has? Like, if I said to you, hey, go to a theme park that has a certain theme to it, you're all going to say, oh, Disney. I mean, it's in a league of its own. They make great content. They have great movies. They own ESPN and all these other things. And sports advertising is going to increase with immense value. I believe, does Disney, what other streaming does it have? What's the family of streaming for Disney? Is it Hulu? Yeah, they have Hulu. So there are major benefits. But the point is, guys, it is possible to overpay for a good thing. So again, if you like what I'm saying, subscribe to the channel. It'll be well worth it. You're going to definitely love that. So let's run it through Stock Analyzer tool. All right. Now, I'm going to do a 10-year analysis. First things first, revenue growth. Now, if you remember from our analyst estimates, revenue growth for the next 5 years was high single digits. So I want to be conservative on the low side and aggressive on the high side. I'm going to go with 4, 7, and 10%. That's a big number, 10%. A lot of things have to happen, but we're in an inflationary environment. If that stays for 2 or 3 years, it could really drive up revenue for the company. Profit margin. I am ignoring the last 5 years of profit margin. This is not a normal profit margin for the company. Same with free cash flow. I'm not even focused on that. That's a fluke. I'm going to ignore that. So I'm going to go with 8, 10, and 12%. Same with the free cash flow. All right, PE. Should I go higher than that, actually? Let me see. Let me see past years. Revenue of $21 billion, profit. I want to go annual, not quarterly. Revenue of $52 billion, profit of 8. No, that's low. I think I'm being low, too conservative on my assumptions for profit margin. So let's go back here. Let's go with 10, 12, 14, 10, 12, 14. PE. Now, guys, big company, high moat, good return on invested capital during normal times, but it's hard for it to grow. The revenue growth is not going to be huge. So I'm going to go with 14, 15 and a half, and 17. 14, 16, and 18. Because, guys, I do believe that it's a very stable company, high moat, It's hard to replicate it. I don't think it should get a really low PE. Even with a low growth rate, it's still Disney, and it still deserves a higher value. Desired return. Now, guys, if you're new to this channel, desired return is where you put margin of safety in. The higher return you want, the lower the price. That's your margin of safety. And the higher assumptions you make, the more conservative you should be. You should ask for a higher return. So I'm going to go with 12, 13.5, and 15. Now remember, you can get 9 or 10% over the long run in a low-cost ETF. So and some people would argue with me and say, Paul, I should make this 10% because you've already been conservative. I understand that. And that's the great thing about the software. It's what you decide to put into it. So for those subscribers out there who belong to our software, put whatever you want in here, but this is what I'm going to do just to see where we stand. The stock is currently down 6.7%. I hit the analyze button. All right. I have it on my watch list at 90, low price of 60, a high price of 120, a mid price of 87. I'm not buying it at 190, but I'm going to start selling puts. Disney is on my watch list. It's a stock I want, but I want it at the price I want it at, not at any price because I love it. So again, subscribe to the channel, watch for more of our videos because we do a ton of them every day. Thank you very much for your time.